I have made millions of dollars investing in the stock markets. And you know what? So can you. But first, you have to learn Wall Street's dirty secret. Many people have been taught to believe that professional investors, fund managers are smarter than you and they've got access to better resources, better tools than you, and so you might as well let them manage your money. They can do a better job than you can do. Or if you don't, at least listen to their advice because they are the smart money. Well, that's an absolute myth and a total lie perpetuated by Wall Street for decades. What's the reality? The reality is that the majority of professional investors, fund managers, actually underperform the stock market index. In fact, Peter Lynch, who is one of the very few fund managers who can actually make money and who can actually beat the market index, he has said that the smart money isn't so smart. The smart money refers to most fund managers. They are not that smart. And the dumb money, which is what the retail investors are usually known as, they aren't really as dumb as they think. In fact, the dumb money is only dumb when they listen to the smart money. In other words, as retail investors, we can actually make a lot of money. But what prevents us is we listen to so-called expert investors on the media, on TV, and that's what makes us underperform and do stupid things in our investments. So before you ever think of putting your money into a mutual fund or hedge fund and let a professional manage it for you, or to listen to their advice on TV, look at these facts. You can see that whether it's a domestic US fund, large cap fund, mid cap fund, small cap growth fund, real estate fund, whatever freaking fund, the majority of these funds managed by professional investors, they underperform their benchmarks, which is mostly the S&P 500. So for example, if you take a look at most of them, you can see that over a 20-year period, over 90% of them underperform the index, which means again you're better off putting your money into the ETF. You'll beat 92% of all these fund managers over a 20-year period. Over a 10-year period, same thing, right? 80 to 90% of them underperform the index. In a 3-year period, 70 to 80% of them on average underperform the index. In a 1-year period, just in a 1-year period, you can see that 50%, 70%, 87% of them underperform the index. Now, if you think about it, the investing world is the only industry where professionals don't do as well as non-professionals. Like, when you think about it, right? A professional doctor who's got a medical certificate should be able to do surgery better than you and me that are not trained doctors. A professional soccer player, a professional musician should be able to play soccer better, play music better than a non-professional. That's true in every profession except investing. In investing, most of the professionals, they don't do better than non-professionals. Now, why? I'm going to explain this in a short while. Just hang on there. Let me show you even more facts that are pretty scary right now. What I just showed you earlier on are mutual funds. Now, how about the world of hedge funds? People tend to be like allured by hedge funds, like, it's for the mega rich. Only rich people can put into hedge funds, and hedge funds are more sophisticated. They can long the market, they can short the market, they can use options and futures. They should be doing better, right? Nope, right? In fact, the majority of hedge funds underperform against the S&P 500. Take a look at the last 10 years. Now, this is up to 2020, right? From 2011 to 2020, check it out. In 2011, the average hedge fund returned minus 5% for the whole year versus the S&P 500, if you just bought the ETF, would give you 2%. Same thing 2012, hedge fund 8%, S&P 15%, 11%, 32%, 2%, 13%, 0%, 1%, 6%, 11%, 10%, 21%, minus 5%, minus 4%, 10%, 31%, 10%, 18%. In no year at all could a professional hedge fund beat simply buying the index ETF. I mean, so what's wrong with these people? Are they morons? Okay, well, not really. Let's find out more in a short while. But again, let me show you even more facts. Now, which hedge fund is the largest in the world? It is called Bridgewater Associates, which was founded by Ray Dalio, who is now retired. Now, you would think the world's largest hedge fund that employs the smartest guys in finance, where, the mega rich, they put their money, they should beat the market, right? The ETF? Nope. You can see that, again, in a 10-year period, from 2012 to 2021, Bridgewater Associates returned 103% to their investors versus if you just put your money to the S&P 500 and just close your eyes with no sophistication, you would have gotten 232%. Okay? Let me make my last point. By the way, what I'm telling you is nothing new. Warren Buffett has said this for many, many years, that hedge funds generally cannot beat the index ETF. So one day, he made a bet. He said, I bet $1 million that if you pick any 5 of the best hedge funds in the world, they can't beat the index over a 10-year period. So this organization, known as Protege Partners, they picked 5 of the best hedge funds in the world, and they made a bet with Warren Buffett that at the end of 10 years, let's see. Now, who won the bet? It's obvious. Warren Buffett won the bet, okay? And you can read this whole article. It's online. And basically, they picked the 5 hedge funds, and collectively, over that 10-year period, the 5 hedge funds, they gain an average of 36%, okay? Versus the S&P 500 in that same 10 years gained 125% return. So, again, what's the lesson here? The lesson is that making money in the stock market doesn't require a lot of intelligence. It doesn't require a degree in economics or a familiarity with Wall Street jargon. But what investors then need instead is an ability to both disregard mob fears or mob enthusiasms. In other words, you must be able to ignore the sentiment in the market. When people are fearful and scared, you cannot get scared. When people are excited and FOMO, you can't get FOMO. You got to be able to invest with zero emotions and to focus on a few simple fundamentals of investing, which is what we teach in our investing course, which is number 1, only buy high quality stocks, the top 1% of companies in the world. Number 2, buy them when they're undervalued. And number 3, have the patience to hold them through the ups and downs and compound into huge amounts of money. It's as simple as that. And anyone can do this. That's the best part. I've done it, so have thousands of students I've taught for the last 18 years, and you can too. You can learn to ignore the noise in the markets, to ignore the predictions of so-called experts, of Wall Street gurus, and just focus on these fundamentals. Now, at this point of time, some of you may be thinking, hey, if the professional investors with all their degrees and resources and million-dollar computers, if they can't beat the market, what chance do I have? You have an advantage that they don't have. So here's the fact. As an amateur, non-professional investor, you have numerous built-in advantages that if you learn to exploit these advantages, you should be able to outperform not just the index, but the experts and the market, and make millions and double-digit returns in your investments. And again, this is something that Peter Lynch said years ago. He said, I've said before that an amateur who devotes a small amount of time and study should outperform 95% of the paid experts who manage mutual funds. Plus, have fun doing it. So as a retail investor, what advantage do we have over these professional fund managers? Well, there are 7 advantages that we have. And these are the 7 reasons why you can outperform professional money managers if you follow the fundamental principles of investing, which is, again, number 1, only invest in the highest quality stocks in the market, the top 1%. These are the only stocks I invest in. Number 2, only buy them when they are undervalued. Be patient, wait for them to be undervalued, then you buy. Number 3, have the conviction and the patience to hold them through the ups and downs in the market, to let them compound into huge amounts of money. And along the way, ignore the predictions of experts, ignore all the bad news, ignore the macro stuff, all that is noise. And most importantly is ignore the fears and the excitement in the market. Focus on the facts, all right? So here are the 7 reasons. Are you guys ready? Let's go. Reason number 1, you can easily beat professional funds is because of fees. Fees. Now, what are fees? Now, management fees. Most actively managed funds, they charge up to 1.5% management fee to their clients. So whether you make money or lose money in a fund, you still pay 1.5% fee to the bloody fund manager. Now, if it's a hedge fund, they charge up to 2% management fee plus 20% performance fee. They take 20% of your profits, okay? So in other words, if you put your money for a mutual fund or hedge fund, you are essentially losing 1.5 to 2% of your money even before you begin through the fees. Now, if you compound that, That's a loss of 18% over 10 years and 33% over 20 years. Now, if you just put your money into the S&P 500 ETF, like the Vanguard VOO ETF, the management fee of the ETF is only 0.03% versus these clowns charging you daylight robbery, all right? And of course, the best thing is like me, if you buy your own stocks, you pay zero commissions. Nowadays, most brokers charge zero commissions, zero fees, so of course you can beat the professional fund managers, right? So that's reason number one. Reason number two, you can beat the fund managers is because you don't have any fund management restrictions. You can buy any stock you want, but fund managers can't do that. They are restricted by what stocks they can buy based on their fund restrictions. For example, certain funds, they are restricted, they can't buy European stocks, for example, but I could buy the top European stocks. I could buy LVMH, I could buy, Ferrari, right? Or they can't buy maybe certain stocks in India or China. They're restricted to a certain market in a fund, right? Second would be a restricted sector industry. So again, certain funds, they can only buy, let's say, healthcare stocks. They can't buy tech stocks. So again, they're restricted, or they couldn't buy a certain stock because the market cap is too small. But for us as retail investors, we can buy any stock we want in any market cap, in any industry, in any sector, in any market, as long as it meets the criteria of a great business. So we've got a lot more flexibility than a professional fund manager. Number three, fund managers may often have to buy stocks when they are overvalued. Now remember, one of the greatest advantages that we have as retail investors is that if there's no stock that's cheap, we don't have to buy. We can just keep the cash in our bank and just be patient and wait for that time to buy. That is our advantage. But for most professional fund managers, they don't have this luxury because in a fund, you have to understand that they typically hold 5 to 10% of the portfolio in cash. And they can't go more than 10% in cash because it's a fund restriction. And if they do keep too much cash in the fund, investors may complain. They're like, we're putting all our money in a fund. Why are you keeping our money in cash? We want you to deploy the funds, right? So because of that, they are pressured to deploy the funds. And sometimes when the market is overvalued, when stocks are overpriced, they have no choice but to deploy the cash in the stocks to keep their cash levels within 5 to 10%. And that is why, over the long run, they can't outperform the market because they are sometimes forced to, again, buy stocks when they are very expensive, okay? But again, retail investors, we have no obligation to deploy cash immediately, and we have the freedom to wait to deploy funds. Fund managers can't do that. So why is it someone like Warren Buffett, Berkshire Hathaway, he's able to beat the market over the long run? Because he doesn't have this restriction. Because remember that Berkshire Hathaway is not a fund. It is structured as an investment company. So Buffett can keep as much cash as he wants. He can be very, very patient, and he only deploys when things are really cheap. Most funds can't do that, right? Okay, number 4. Here's the funny thing. When a fund becomes more and more popular, it is more likely to self-destruct. So in other words, a fund may start off doing very well. The fund manager picks great stocks that are undervalued and they perform really well. And when they perform really well, what happens? They attract more and more investors. And the more and more investors come in, the fund would usually self-destruct. This is because the fund manager is increasingly forced to invest more and more cash at more overvalued levels. You see, the thing is, fund managers, they get paid as a percentage of the assets under management. So it's the incentive for the manager to get as many investors as possible, okay? And the problem is that, again, initially when they invest in a stock, they could buy when it's cheap, for example, okay? And after the stock price has gone up, their fund does very well, right? And then they attract a lot more new money. But when the new money comes in, where do they put the new money? They have to put that new money into that stock which they bought earlier, which is now very high. So it forces them to now buy stocks at a higher and higher price, which eventually is not sustainable because it's overpriced, and eventually when it drops, the whole fund implodes. And this is exactly what happened to ARK ETF, right? So ARK ETF in its early years, it bought stocks when it was still cheap, when it was still undervalued, and they bought more and more and more. And of course, they bought a lot of the high-tech growth stocks that went up like crazy, and they looked like geniuses, like we are so smart. And then everyone said, wow, ARK is fantastic, ARK is the best fund. So everybody put their money into ARK, except me, right? So when ARK got all this cash, what could they do with the cash? They had to invest the cash, right? But by that time, Tesla was already so high, and this was so high, and that was so high, and they had to keep deploying the new cash in these stocks that were already so high. And eventually, of course, it was not sustainable when interest rates rose very fast. These unprofitable tech stocks, came down, and the whole ETF exploded, right? It imploded, if you will. And that's why, if you guys remember, I actually put up this video, which was, in fact, more than 1 year ago. It's now like 2 years ago, where I warned about the danger of investing in ARK ETF. Number one, they were buying companies that were unprofitable, they were overpriced, and they had so much cash coming in that they had to deploy it at higher and higher levels, and it was just not sustainable, right? Okay, next, we have reason number 5. And reason number 5 is this. The reason most fund managers cannot beat the index is because most of them are very short-term focused. And I don't blame them. Most of them have to be short-term focused. Why? Because if fund managers underperform the index, or they can't make money for a couple of quarters, they run the risk of investors withdrawing their funds. Because most investors, unfortunately, are also very short-term focused, and they may risk getting fired as a fund manager. Okay, so because of that, fund managers, they think very short-term, like I have to beat the market every month, every quarter, right? So as a result, they focus on buying stocks that everyone is buying to ride the momentum. They buy stocks that are in favor, all right, and they avoid stocks that are out of favor. So by doing that, they tend to buy stocks that are so-called overvalued because they're in favor, everyone is buying them, and they avoid stocks that people are not buying, and so they avoid the undervalued stocks and they buy the overvalued stocks. So in the short term, they may outperform once in a while, okay, by following the herd consensus picks, but in the long run, they can't beat the market because they are always buying stocks that are expensive and avoiding them when they're cheap, right? So we know that to beat the market over the long run, great investors like Warren Buffett, Charlie Munger, Monish Prabhai, Peter Lynch, you have to be contrarian. So what does contrarian mean? Contrarian means that you have to buy stocks when they're out of favor, when everyone hates it, when no one wants to buy it, that's when you buy it. It's like very few fund managers bought Meta last year because Meta was hated. Everyone hated Meta when it was down like 80%, right? But that was the time I was buying Meta. My students were buying Meta. The great super investors bought Meta when it was hated. That's how you got it at 50-60% discount. And that's how this year you're beating the market. I mean, I'm beating the market this year because I bought stocks like Meta when it was hated last year. But most fund managers, again, they avoided tech stocks last year. They bought energy stocks that was in favor last year. They bought utility stocks in favor last year. And that's why they underperformed this year, right? So, but because super investors buy stocks that are out of favor, that are hated by being contrarian, they often experience significant short-term drawbacks and underperform the market over a few quarters, but outperform the market over the long run. Okay? And that's what made Peter Lynch very different. Remember, Peter Lynch is one of the very rare fund managers that beat the market in the long run. Why? Because in the short term, he didn't mind underperforming because he was long-term focused, he was not short-term focused. And this chart shows you the result. When Peter Lynch managed the Magellan Fund over 13 years, he achieved 604% return versus the S&P 500 of 200%. So he beat the S&P by 3x. And his annual return was 29% versus the S&P, which was like 10%. And the only way he could beat the market in the long run was by being long-term focused. But because of that, in the short term, he often underperformed the market in the short term. So for example, you can see that, when the market dropped 20%, his Magellan Fund dropped 56% because he bought stocks that were hated. He was a contrarian, right? When the S&P dropped like 5% here, his Magellan fund dropped 27%. When the S&P dropped here, so in other words, every time the S&P dropped, his fund would drop even more than the S&P. But over the long run, whenever the stock market index went up, he would go up a lot more than the stock market index. Does this make sense? In other words, short-term periods of underperformance enables long-term outperformance. But the problem with most people and most fund managers is because they focus on outperforming in the short term, that they sacrifice the long-term performance. Reason number 6 that you can outperform professional money managers is because professional fund managers are often forced to sell their best stocks. But as retail investors, we are not forced to sell our best stocks. We can hold our best stocks and keep on letting it grow and multiply and compound into millions of dollars. You see, the problem is that common portfolio management guideline is that no single stock can exceed 5% or maximum 10% of the total portfolio. So for many fund managers, they've got a rule that says there's no one stock that can make up more than 10% of their portfolio for the purposes of diversification. So if they buy one stock that does very well, that goes up 5 times, 10 times, and now that one stock makes up, say, 20% of their portfolio, they can't keep that 20%, right? They are forced to sell that stock in order to bring it back down to a 10% or 5% allocation. So this is why they can't beat the market, because what you find is that people like Warren Buffett and Peter Lynch, Charlie Munger, they are able to beat the market because out of all the stocks they pick, they've got a few stocks that went up tremendously. They went up 5x and 10x and made up for a huge amount of the gains of the portfolio. And they didn't sell it. They let it run to its maximum. Like Warren Buffett, as you guys know, he bought Apple many years ago, and it was a small position in his portfolio. Well, not that small, but it was a normal position, right? But because Apple did so well, today Apple makes up 40% of his public equity portfolio. 40% of his portfolio is in Apple, public equity, right? And people were saying, hey, shouldn't you sell Apple? It's like too big in your portfolio. And he said, no, as long as Apple is a great company, Apple is still growing, it makes sense to sell Apple. And he said that if you sell your great stock, it's like cutting the flowers and watering the weeds, right? So selling great stocks and taking the money and buying stocks that are not so great is like cutting the flowers and watering the weeds. It is insane. What I found as an investor is this, is 20-80 rule. You will find that 80% of the gains in your portfolio come from 20% of your stocks. Now, you never know which is the 20%. That's why the 20% of the stocks in your portfolio that really do really well and run, let it run. Don't sell too early. The trouble with a lot of people is they take profits too early and they don't allow an investment to reach its fullest potential. Okay? All right, last reason why you can outperform the professional money managers is because professional fund managers, they tend to perform excessive portfolio reallocation to avoid short-term underperformance. Again, like I told you, a lot of fund managers, they are afraid they lose their job. They're afraid their clients pull out the money, so they are like so afraid that their fund will go down. So they tend to like jump in and out of stocks. They think, okay, this stock has gone up a lot, let me sell it before it goes down. And they jump in and out of stocks. In other words, they try to time the market. So for example, if they think that, a recession is coming, they sell the cyclical stocks and buy defensive stocks. If they think, the economy is gonna boom, they will sell their defensive stocks and buy the cyclical stocks. And the trouble is that timing the market is very tempting. I mean, who doesn't want to time the market, right? To sell at the top and buy at the bottom. Everyone wants to time the market, but it's been proven time and time again that most people who try to time the market and jump in and out will often underperform the markets over the long run, okay? Because there's always a risk of mistiming. In other words, you sell a stock hoping that it's gonna go down, but it keeps running up, and you go, right? Or you sell a stock and you say, I'm gonna buy it back lower, and after you sell the stock, it comes down, but before you have a chance to buy it back, it runs up again. And I'm sure that has happened to you before. It happened to me many times in the past, where, again, I sold Apple, I sold Facebook, I sold Amazon, I sold Nvidia years ago, and I bought it back and I sold it. I jumped in and out, right? And I made money, but I've come to realize that if I just held on to these great companies over the last 10, 15 years, today I'll be a lot richer than trying to time the market perfectly. Because remember that time in the markets is more important than timing the markets over time. So now you know the disadvantages of professional money managers. Let me now summarize for you as a retail investor how we can beat them, outperform the market, and make our millions. And these are 6 keys that we need to follow, right? Number 1 is, again, to only invest in the fundamentally strongest stocks in the market. And again, you can be in any market. Buy the greatest companies in the US, in Europe, in India, in China, whatever it is. Only invest in the top 1% of companies in the market. If you take my value momentum investing course, you know that I've got a 7-step criteria of choosing the top 1% of companies. And again, when do we buy them? We buy them when they are hated. We buy them when they're going through bad news. We buy them when there's panic and fear in the markets. In other words, we must be greedy when others are fearful. We buy them when they're significantly undervalued. So most of the time, the best companies in the world are selling at a premium. We gotta wait for them to be cheap and then we pounce, all right? Number 2, so you gotta be patient for that to happen. You can't have that FOMO. You can't let emotions affect you, all right? Number 2, you must learn when to hold cash when there's nothing great to invest in. So be patient. You are not forced to deploy your cash all the time. I keep telling my students is that if there's nothing to buy, don't buy. Keep cash, right? Or keep some cash and deploy when the time is right. Number 3, short-term volatility is your friend. So don't be afraid of volatility. Be greedy when others are fearful. Number 4, keep holding stocks through short-term volatility. Do not be tempted to jump out of the market and jump in to try to time it in order to always beat in the short term. Because remember that trying to outperform the market in the short term will tend to lead to underperformance in the long run. Have a long-term view to grow your wealth. Number 5, hold on to winning stocks as long as the underlying businesses remain great. Don't make the mistake of selling a stock just because it went up 80%. Because a great company that remains great can go up 2x, 3x, 10x. Why are you taking profits so early and not allowing the company or the stock to maximize its fullest potential? Remember that the 20-80 rule, 20% of your stocks will account for 80% of your gains, okay? The final thing is you can also learn to use options to turbocharge your return. So besides investing in great companies that are undervalued, I also use a lot of option strategies like cash secured puts. So I get paid to wait every month for the stock to drop to my level to buy. I also use credit spreads. I use covered call strategies. And through a combination, I'm able to beat the market consistently. So to give you an idea, this year alone, I'm up about 33 to 38%. And I've made about $1.5 million this year in the markets. Over the last 5 years, despite 2 bear markets, a recession, a banking crisis, a pandemic, and the fastest interest rate increase, I still managed to double my money with a 127% return versus the S&P 500, which was a lot lower. And you can see the chart over here. The blue line is my portfolio performance versus the S&P 500. Now, again, it doesn't mean that my portfolio goes up every day, every week, every month, every year, right? My portfolio goes through drawdowns as well, just like Peter Lynch, My portfolio went through a drawdown back in 2020 during the COVID crash. It also went through a drawdown last year during the 2022 bear market. So no matter how great an investor you are, you will go through ups and downs. You will go through volatility and drawdowns. But as long as, again, you stick to the investment rules, you find that you will be able to beat the index and make really good money over time. So I hope you enjoyed this video and I hope you learned something from it, and I hope that you too can get better returns than most of the people out there. So may the markets be with you, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.